Hi friends, Simon here from InformedTrades.com. In today's video, we're going to talk about the whole dividend cycle from when a dividend is announced to when it is paid out, the ex-dividend date, what that is, as well as dividend capture strategies, which are strategies centered around capturing dividend payments and just moving on, just owning a stock for a short amount of time, getting the dividend, and moving on to the next stock. Let's get started. Okay, key points about the ex-dividend date and dividend capture strategies. First, we need to understand what the ex-dividend date is, which is the date by which you need to own the stock to get the dividends. That's true for all dividends except special dividends, which if they're greater, which are dividends where the yield is greater than 25%. They'll have different ex-dividend dates. We'll talk about that. Dividend capture strategies are difficult because of taxes and commissions. So while a strategy may have some appeal because it may seem risk-free, when you actually look at taxes and commissions, there's a bit more to it. And ex-dividend date is also important. It's important administrative information for income investors just to know what date you need to have the stock to get the dividend stream. Okay, how ex-dividend date works. Now we'll just map out the whole dividend issuance cycle. First, there's a declaration date. That's where the company's board of directors announces that they'll pay a dividend, and when it will be paid, the amount, and the other dates to follow. Second is the ex-dividend date. This is the date on which the stock will trade without the dividend. So if you buy the stock on the ex-dividend date, you are not going to get the upcoming dividend payment. Often on the ex-dividend date, because the stock is trading without the dividend, you'll see the stock price fall, which relates to dividend capture strategy that we'll talk about shortly. But if you want the dividend, the simple rule is own the stock the day before the ex-dividend date. If that's the period that's going to be looked at. If you're on the system, on the register, as a shareholder, on the day before the ex-dividend date, you'll get the dividend, the forthcoming dividend. The record date is the date, usually it's 2 days after the ex-dividend date, 2 business days after. And that's where they look at the day before the ex-dividend date to see, all right, these are the people that are actually going to get the dividend. So that's the day that the information is recorded. It occurs 2 days after the ex-dividend date, but they're looking at the day before the ex-dividend date. And the payable date is the date that the dividend is paid to the shareholders who had it the day before the ex-dividend date as determined on the record date. Okay, an ex-dividend example. Imagine this. We're looking at an old slide here. May of 2010, May 26, 2010, dividend is announced. Board of directors says, all right, we're going to pay 10 cents per share. We're going to do that sometime in October, and they'll announce the ex-dividend date and the record date as well. When they announce the dividend, they announce that September 16th is the ex-dividend date. So that means you have to own the stock on September 15th. You have to be the recorded owner on September 15th to be eligible for this dividend. And then they're going to evaluate that September 25th. There's a larger gap there. And again, like we mentioned, it's usually 2 business days, sometimes before, sometimes it's later. But however, all that information should be denoted in when the dividend is announced, which in this example is May 26th. And then usually shortly after the record date, let's say within a month, the actual dividend is paid. And that's paid to the people that had the stock on September 15th, the day before the ex-dividend date, and the amount that's paid is what was stated on the May 26th dividend announcement. Okay, special dividends have a different schedule like we discussed in our first slide. Special dividend is a one-time dividend with a yield that's greater than or equal to 25%. So often a company may just have accumulated a lot of stock or a lot of cash. Microsoft had this situation a couple years ago, and they're just going to do a one-time disbursement to their shareholders. It's not necessarily related to ongoing earnings. It's not something that they plan to do regularly on a quarterly basis. This is a special dividend one time. When a special dividend is greater than or equal to 25%, the ex-dividend date is after the record date. So you need to hold for a longer period of time if you're a shareholder and you want to be eligible to. And that's easier to understand through an example. Okay, so here is a company called Cambrex. They issue a special dividend. First comes the declaration date. They announce the special dividend. Then comes the record date, right? Shareholders at the close of April 20th will have a right to the dividend, the special dividend. Then comes the payment date. Now, here's the tricky part. If you sell after the record date, but before the payment date, then you actually have to give the dividend back to the company, and who in turn will give it to the shareholder that had it on the payment date. So that's why in the case of a special dividend, just hold to the ex-dividend date, which is they switch the order and that's all the way at the end. And remember, as a reminder, the ex-dividend date, what that really means is that's when the stock trades without the dividend. So you'll see normally a share price decline on the ex-dividend date because there's no longer a dividend associated with that stock. So in the case of a special dividend, hold all the way through the payment date up until the ex-dividend date. And then you can disclose it or let go of the share, and you can still hold on to the special dividend. If you sell it, as noted here, if you sell it after the record date, before the payment date, you're going to have to give that money back. Okay, now that we understand ex-dividend dates and so sort of the whole dividend cycle, starting from when the dividend is announced to when the dividend is paid out, we can explore dividend capture strategies. Now, these are strategies that pertain to capturing the dividend of a stock, owning it for a short amount of time, capturing the dividend, then moving on to the next stock. Or conversely, shorting the stock based on the transition from being a dividend stock to becoming an ex-dividend stock. Something to bear in mind with dividend capture strategies is that there is often a higher tax rate on dividends held for a shorter amount of time. So if you, and this varies from jurisdiction to jurisdiction and based on other factors, but as an example, in the United States, if you hold a stock only for 10 days, excuse me, and you capture a dividend as a result of that, you'll pay a higher tax rate on that dividend than if you were to have owned the stock for several years. As I mentioned, some jurisdictions, it's different, and this impacts the effectiveness of dividend capture strategies. There was one study a few years ago that suggested Australia was a favorable environment for making dividend capture strategies work. The basic idea is that the opportunity is, you take the negative amount that you had to pay to get the stock, then you're going to sell it ex-dividends when it trades without the dividend. And hopefully that you add that back in because you're getting that money back. You subtract commissions, and then you add in the net dividend after taxes. If that number is positive, the negative buy price plus the amount you get for selling it after dividend minus your trading commissions plus the net dividend after taxes, if that number ends up being positive, you have an opportunity and you've just made money with a dividend capture strategy. Conversely, from a short perspective, when you short the stock, the price you get for shorting the stock before the ex-dividend minus the price you buy it back on the ex-dividend, minus commissions, and minus the dividend. If you short before the ex-dividend, you are responsible for the dividend. You'll have to incorporate that, pay that dividend cost when you short the stock. Okay, so let's actually put some numbers behind it to help walk through the example. Let's say there's a stock trading for $20 that has a $1 dividend. Okay, so I buy the stock for $20. Okay, after it goes ex-dividend, its price drops by $1. Now, in a perfect market type of thing, the stock price should drop by the amount of the dividend. So if we're assuming $1 per share, ex-dividend is going to drop $1, which in this example would mean $19. Now, often, things don't work out perfectly. The market isn't a perfect, example like that. So, and that often creates the opportunity. But in this particular example, let's say, you bought it at 20, you're going to sell it for 19. You have to take out your commissions, which we're assuming are a nickel a share, 5 cents a share. And your net dividend, we talked about how the gross dividend was $1, but you pay taxes on that. If you're holding it for a shorter amount of time, you're going to pay a higher tax rate, which we assumed here. So let's assume that the net dividend after taxes is 65 cents. Negative 20 plus 19 minus 0.05 plus 0.65 gives you negative 0.40. So that opportunity does not work. Again, the key variable there maybe is the selling price, right? If you can actually end up selling it, if the stock doesn't fall by as much as the net dividend, you might have an opportunity, right? So if you were able to sell a stock for, $19.70, then you get 70 cents more, and now we're talking about a profitable trade here. Okay, conversely, the short opportunity, let's look at that. So you short the stock on the ex-dividend, you're going to get $20. You buy it back, when it starts trading without the dividend, and you're going to get that for $19. So there, you made a profit because the stock fell on the ex-dividend. However, you have to pay commissions, which we assumed was 0.05 per share, and you also have to pay the dividend and the gross amount, which is a dollar. So in this example, you also lose 0.05. The real opportunity in dividend capture strategies is getting your commissions low enough, being in a jurisdiction where the taxes don't impact net dividend too much, and also, most critically in my opinion, is looking at the ex-dividend date and understanding, finding a time where it's going to trade as high, preferably higher than the dividend, right? If you can sell a price above, if the difference between the buy and sell price is is less than the net dividend, then a dividend capture strategy could work really well. And that's sort of the key. So if you can break even on buying and selling and just make the net dividend, you've got opportunity there. Unfortunately, it usually doesn't work out that way. And that's about it for our video on dividend capture strategies and ex-dividend and the whole dividend cycle. Any questions you have, anything you want to add, join us at informedtrades.com. Help us make better videos, make a contribution at informedtrades.com/donate. Also, if you like this video on YouTube, share it on Facebook, Google+. That also helps us get the word out, helps us grow as well. Best of luck in your trading and investing, and we'll see you next time. Take care.